The broadcast is now starting. All attendees are in listen-only mode.
All right, good afternoon, everyone. It's Bobby Rains here again to talk to you for our once every 3 weeks members only workshop. It's October 3rd today, which is 3 weeks from the last time we did this, so let's get started. So our agenda today is going to be a brief look at the market, a brief note about what's going on in InvestorsObserver, and then member-driven content, questions, site demonstrations, whatever it is that those of you who are here would like to ask. And also we had some questions submitted ahead of time. As always, if you could submit questions ahead of time, I can put together some slides and talk about things in a little more depth, and you might get a little bit less ums and ahs than if you ask me in the webinar, and I have to think up the answer off the top of my head. Which is not to say you won't get ums and ahs if I have slides or, yeah. Anyway, all right, so let's look at the market update. All right, so S&P 500, I drew this line here because this line is roughly where we were last time we did this. We had just sort of bounced from here and we were somewhere in this area. I think maybe there's about 15 candles from here to today. So that's where we are on the 1 year. If we go to 3 months, find my spot again here. Yeah, so here's that resistance testing that we were just looking at where the line was, and then back up to here. The thing that stands out to me here is we haven't really gone very far from this high to here, and then we tested it again. We're testing it again today, and also some big wicks, especially to the upside, which those are usually a sign of indecision. So we'll see what's going on here. There's earnings season, right? The last day of the quarter was Friday of last week. So earnings season is between 15 and 45 days after that. So that's about 2 weeks away. So that should provide some momentum to markets, but we'll see how it goes. All right, and this was an interesting one. So year to date here, we've got the Dow and the Russell 2000. And you can see the Dow outperformed in the early part of the year. And then when everything was selling off, they both kind of went down. But then the Russell outperformed the Dow for most of the year until recently, where the Russell, which is small caps, have really rolled over, and the Dow has been pretty strong. It's hard to know exactly what those things are about. The Dow, everybody said, was weak on trade, and so I don't know. Maybe people are more optimistic about trade than they were. I'm not 100% sure I buy that as an explanation. Maybe it's interest rates. It's hard to say, but it's been an interesting closing of a big divergence that we've seen here. So that's the thing that lots of people are looking at. I've seen it mentioned in, I don't know, some number of articles I've read this week that the Russell was back up today, which was nice to see, but it was pretty ugly over the last week or so. Whereas the Dow and some of the broader indices have been a little bit stronger. You can see this a little bit in the NASDAQ, even if you compare the NASDAQ composite to the NASDAQ 100. The smaller index that just looks at basically the bigger companies has been relatively a little bit stronger than the broader index that includes more of the smaller companies. So it's hard to know exactly what that means, but usually, over time, these things sort of track together. So it's a little bit when you get a big divergence like that of things going strongly in different directions, it's kind of interesting to look and see which one is going to adjust to sort of resolve the divergence. All right, and what else is going on in the market is earnings starts in 2 weeks. The market is still reacting to trade headlines, but the effect is still pretty short-lived. We had a sort of reversal this week where typically the trade headlines have been negative. In this case, it was a positive. We had got a North American trade deal, but the rally from that didn't really last very long. We got a pop Monday morning and then spent the rest of Monday and most of Tuesday giving that back. I guess the Dow hit a new high today, but it was not very much higher than the high set Monday. So yeah, there's not a lot of strength in some of the broader indices there. It doesn't really seem like this new North American deal is that much different from the current one. So we'll see how that goes. And then economic data still points toward continued growth. There's no real weakness or slowing there. And then we got Jobs Day Friday. The Jobs Day is not what it used to be in terms of being super exciting for the market. Still expecting to see about 200,000 new jobs and unemployment around 3.8%, which is in the trend it's been in since, 2010, 2012, something like that. It's been a while. And so, yeah, the wages number will be interesting. You look for an increase in hourly earnings. And so that is a measure of, well, obviously it's a measure of wage growth. Some people think it's a measure of inflation. Also, probably what it is more a measure of is how much longer we can keep adding 200,000 new jobs without, once wages start to really rise, you're going to see probably either hiring will slow down or it will be a sign that we're running out of people to suck in who aren't in the labor force. I'm not sure which one of those happens first, but I guess we'll see. All right, so now it is time for what's going on at Investors Observer. And with that, I will turn things over to our Member Success Coordinator, Rob Silverman.
Hey there, everybody. Just wanted to give you a heads up about something that's going to be coming up here pretty soon. We're in the midst of working on adding some exciting new features to the Investors Observer website, and as part of that, we are trying to convene a beta group of engaged users to help us out with that process. And since those of you who are here at the webinar are some of our most engaged users, we thought we would give you the opportunity to be the first people to join us for that. So I also made this offer a couple of weeks ago at the last webinar, and for those of you who signed up, you should be expecting an email in the next week or two. I haven't forgotten about you. But for those of you who are hearing about this for the first time or just now interested, you can either write in via our support link on the website. You can give us a phone call at either of our phone numbers, or you can email me directly, and I'll drop that email address in the chat box here after I'm done talking. Just put beta in the subject line and you will be added to the group. We're expecting to get started here in just a couple of weeks, and we'd be thrilled to have you. So if you're at all interested in testing out new Investors Observer features and helping us out with giving you the best possible service we can, we'd love to have you. And yeah, that's about it.
All right, thanks, Rob. All right, so we're into the questions now. I see a couple questions coming in already. We will get to those. But first, we had some questions from users I want to get to. The first one was from Lee, who wanted to know a little bit about bullish diagonal spreads, how to calculate break-even price, relationship between the bought leg and sold legs. So here is a sort of sample diagonal spread. I took out all of the identifying information mostly to keep from having to make a new diagonal spread slide, but the price data is what really matters. First, let's start with your basic why is it diagonal? So a vertical spread is two different strike prices expiring at the same time. And a horizontal spread, which is more traditionally called a calendar spread, is usually roughly the same strike price expiring in different months. And so if you think about those two things, and then, okay, so a horizontal spread is same strike price, different months. A vertical spread is different strike price, same expiration. Well, it stands to reason that different strike prices, different expirations would be diagonal because it is somewhere between vertical and horizontal. So that's where that comes from. And so, yes, the sold option usually expires soon and the bought option expires less soon. You know, how you want to structure these can vary. Some people will do them for super short. And obviously, if you sell a very short dated call, you don't need a super long dated call on the bought end. Some people will buy, you know, the longest leap they can so they can sell calls against it a bunch of times. The trade idea generator and our diagonal spreads portfolio usually is looking at, in terms of the sold call here, it's usually weeks to months, and then the bought call is usually usually several months, and usually we want to be able to, if possible, turn that sold call at roughly the same interval twice or 2.5 times even. And so that just means that if we're doing if say we did do a 1 month sold call, then we'd want to be able to have another month we could sell and then at least another month on top of that. And I think we actually keep the bought legs to be at least 90 days. So that wasn't the best example, but if we did 2 months, then we'd want at least 6, 9, something like that in terms of the bought leg, because we do like to be able to sell it again. And that's because of reasons like position repair, which we'll talk about with some of the later questions, is that you get some flexibility if you have that bought leg not expiring super soon. All right, so this was constructed with a stock that was trading at 159.44. So yes, you could spend basically $16,000 to buy 100 shares of the stock. Or you can do it for way less by buying in this case, a 130 call for 31.05 per share or 3,051. So yeah, that's our net debit. So that's the cost of buying the call less what we bring in from selling this call. So for roughly 20% the cost of buying the stock, we can make a diagonal spread. And so what that means is, you need a lot less capital, and also it means you can frequently get higher returns on a percentage basis, right? I mean, if you make $1 on $16,000, you're making a much lower percentage than if you make $1 on $3,000. So it doesn't always work out like that, but typically you make a higher percentage return as well. So that's the basic gist of it. And the way it works is, okay, it's very much like a covered call. Other things you'll hear diagonal spreads called is like synthetic covered call or poor man's covered call. And the gist of it is, right, the sold leg still is an obligation to sell the stock at 165, except we don't own the stock. What we instead own is the right to buy the stock for 130. So if we sell at 165 and then simultaneously buy it at 130, that brings in $35, and our net debit here was 31.05. And so what we make in profit is the difference. It's the same basic idea as a covered call, except it's a little bit levered, and obviously you need a lot less money up front. So the important terms to know with a diagonal spread are net debit. That's your cost to enter. Okay, so what you pay to buy that long option less what you bring in from selling the sold option. Okay, and the break even is typically it is, the way we calculate it is essentially the bought leg strike plus the net debit. So to go back to this example, the break even here is the bought leg strike of 130 plus the net debit is 161.05 is our break even. So above 161.05, we should be able to get out for a profit. Below that, we're probably looking at a loss. It's not, obviously it depends on the day in terms of exactly the price you can close a thing for, but that's as you're managing the position, that is a good rule. All right, and the strike width is the difference in strike prices. So to go back to here again, we're at $30 or $35, right? 165 minus 130, 35. And then the target profit is, as I said earlier, the difference between the net debit and the strike width. So if we pay $31.05 to get into the position, and then we close the position for $35, our profit is, what is that, $33.95? So that's that. There's your diagonal spread basics there. And I think we have a video in our Learning Center about that goes into a little more depth there, but that's the basic. What you need to know is it's a lot like a covered call, except instead of buying 100 shares of the stock, you buy an option, and that covers the obligation that is created with the sold call. That's why it is you have to do that. All right, more questions from subscribers. This one was from Bob. He had some questions about defending credit spreads. All right, so, well, let's read these one by one. So first was, if he thinks his directional bias is correct and the short position has around a 50 delta, roll the whole thing out for 1 or 2 weeks, but that requires a broker that can handle a 4-legged order. He says he's used this method a lot. It's worked well as long as the stock moves in his direction. Otherwise, it gets really messy. So part of the reason it gets messy is a lot of times if you've rolled that, you're going to have a lower credit than you did originally. It's possible to do it for break even. It may be possible to do it for a slightly higher credit. But typically in this case, the stock has moved against you. So it's not, you're not always, you're not always rolling it to make a bigger credit. And then, you still have the same amount at risk or more if your credit is smaller. So that's why it can get really messy. If the direction has changed, he'll buy back the short option and let the long ones run, which now you're changing from a credit to a debit. Now basically you just have a long and out of the money option that you bought, but you bought it at a relatively high price. And then what about making it into an iron butterfly or an iron condor? And I'll talk about that here in a minute. If he's unsure of the direction and the short side is being threatened, what if I roll out the existing position and convert it into an iron condor? And then when should I keep the original spread and buy some long options as protection? I could take them off if the situation improved. All right, so I'm going to go through these one by one here. And that straight roll can work if the stock goes back where you wanted it to, but it can also make a bad trade into a worse one. I mean, basically what you're doing is buying time by rolling it out. And like if the stock goes back where you thought it was, again, right, like if your directional bias is correct and you just got the timing wrong, it can work. But if you're actually just wrong, then it can make a bad trade into a worse trade. Buying back the sold leg to let the long one run is a thing I've considered, but I've never pulled the trigger on it because, like I said, it turns a credit into the debit, and you need the stock to go against your original direction pretty hard. So, maybe in the case of like there was bad news or something, but even then the stock would have to like go bad and then keep running by the time you bought your sold option back to make that really work. So it may work, but I'm not sure. It may also just end up with a slightly bigger loss than if you'd closed both legs at the same time. Okay, and then like rolling a vertical spread is closing one position, so you're going to close both legs and then open a new position. And my general attitude about these has always been, if you're already closing a position and opening a new position, why not pick something you feel more comfortable about? I mean, if I was just wrong on a given stock, I'm not sure I want to open a new position in that stock because it feels like my ability to guess what it's going to do is probably off a little bit. I maybe can find something I like more somewhere else. So that's generally how I feel about that. And then in terms of keeping the original spread and buying some long options as protection, it's kind of betting against yourself, right? So if you have a bullish spread, you've got a levered long, okay? And so if you think that's going bad, what you want to do is close it, not bet that it'll go bad and hope that the bet you made on one side will balance out the bet that went bad on the other side. The value of trading spreads, especially vertical spreads, is small position sizes. So use position size for risk management. Don't just try to hedge everything every which way from Sunday, because you end up paying a lot in transaction costs and not actually making very much money. So again, I mean, this is a long way of saying I still don't really believe too much in trying to make a lot of complicated trades to play defense on a vertical spread. If you think it's more likely to go bad than it is to be good, try to get out for the best you can. Still is the best strategy for those that I have seen. All right, and then we had some more questions also from Bob on diagonals. So this is a specific question about our electronic arts trade in the diagonal spread portfolio. And so the question is, it looks like it's in a range of 100 to 120, and it's unlikely the $100 call will break above 30, which is about where our original target profit was. So we'd need the stock to get to 130 before it expires. If I'm bullish on the stock and willing to wait, what can I do now to generate cash? And what action can be taken as we approach the expiry of the long position to present a bigger loss? Roll the position out and down. So that would be sell our current call, which is 100, and buy a new one at a lower strike. And if this was a covered call and I still like the stock, I'd buy more stock, lowering my cost basis, and then write short-term calls that are close or just outside of the expected move. Moving strikes up as the stock improved in price, rolling up and out. Hopefully we can close the position at a profit or break even. So the first thing we have is EA reports earnings on the 30th of October. So that's about a week before that call expires, which we're probably not going to hold it through earnings, just because I don't really want to take on the risk. And we will be looking to sell more calls. We looked at doing it earlier this week, but while the stock was rising, I didn't really want to cap ourselves out. But yeah, we are actively looking at that to try to get as much as we can there. And instead of rolling, you can always exercise the long leg and turn it into a covered call. So a bought option gives you the right to buy the stock at the strike price. So you have a $100 call, you can buy the stock today for $100. If you want to hold it through earnings and past that November expiration date, that's probably the way I would do it, as opposed to rolling. Make it a long stock position. It will cost you a lot more in terms of the amount of capital you need, but I would do that as opposed to rolling it, because I don't know how many times I'm going to have to roll it. And again, you get into, right, you're buying option premium anytime you do that, and you're selling less option premium, and there's other transaction costs you have to deal with. The bid-ask spreads on those in-the-money options tend to be a little bit wider. So rather than continually rolling the thing, it seems like it makes more sense to me to just turn it into a covered call. But again, rolling the long is just a sell to close and then a new buy to open, which is basically closing one position and opening another. It makes sense if you just don't want to take a loss on EA, but you're still basically closing one position and opening another. So unless you just move the stock, I still am not sure why not move on to another name. Yeah, I mean, that's a matter of personal preference. I guess maybe there's some tax or other accounting reasons to not do that, but we're probably going to move on. I would like for EA to come back, but I'm not really willing to hold it through earnings based on how it's traded over the last month or so. And it's at it was at as high as about 120 earlier this week. I think it was 116 or 117 at some point today. So that's $16 or $17 per share. I don't know, some of you probably remember we tried to hold a Skechers diagonal through earnings earlier this year. but we had about $6 per share at risk on that one, and so I was comfortable with that. Whereas this one, where it's closer to half the position as opposed to that was maybe a quarter of the position. That one was pretty ugly before earnings. I'm not willing to take the risk there. So we'll be out of this guy before earnings. In any case. All right. So we had another question from Dave. He said the out of the money covered call window usually shows about a 30% probability of assignment. Is there any way to determine probability of assignment for other strikes or calls? And the answer is yes. The answer is delta. So this is the definition of delta from Investopedia, a ratio comparing the change in the price of an asset to the corresponding change in the price of its derivative. So in this case, the asset is the stock and the derivative is the option. For example, if a stock option has a delta of 0.65, this means that the underlying stock increases in price by $1 per share. The option will rise by 0.65 per share, all else being equal. And by all else, they mean time to expiration, risk-free interest rate, and the various other things that go into the pricing model. But those are the big ones. It's stock price, interest, time to expiration, and some metric for volatility. All right, so yes, delta can also tell you the probability that an option will expire in the money. So yes, if it does this price thing in terms of being able to predict what the price will do for a given move in the stock, but it is also predictive of the probability that an option will expire in the money. So the 30 delta calls you're seeing on the out of the money covered call generator have about a 30% chance of being signed. 50 delta will be right at the money and is pretty much a toss-up, right? 50-50. And deltas approaching 1 are very likely to be assigned. And this is always a fun thing. I don't know, it's fun for me anyway, to think about. Right, so you have an option that's way out of the money and it has a delta of say 10. So if the stock goes up by $1, that option will gain 10 cents. And conversely, if something's very far in the money, right, at a delta of 1, the stock price goes up $1, then the option price will go up $1. And so yeah, these things tie together. So if you had a call with a strike price of 0, the delta would be 1, and the price would move penny for penny with the stock because they would be identical instruments, right? Like you would buy the stock essentially for $0, and right. So if you think about the extrinsic value, right, exercising that today, you buy the stock, and it's all, or excuse me, intrinsic value, right? A deep in the money option like that would have a ton of intrinsic value. It would be basically all intrinsic value. And it would be intrinsic value that is exactly the amount of the stock price. So if a stock is $5 in the money, it has $5 of intrinsic value. If the call has a strike price of 0, it has exactly what the stock price is of intrinsic value, and it will move dollar for dollar with the stock. Now, calls with a strike price of 0 don't really exist. You see them in weird hedge fund transactions sometimes when some activist investor is trying to quietly control a bunch of shares. But it's not, it's entirely theoretical in terms of this exercise. It's not really a thing that exists, but that, right, you can see how the probability and the strike price move align with each other in terms of, taking it down to its sort of most basic element. All right, so that's the end of the pre-submitted questions. Let's go to what has come in so far. All right, so one from Rick, and I think I have an answer to this, but let me check. So Rick's question is, the home and dashboard buttons go to the same page, which you can set a home page, which may fix it so that doesn't happen. Yeah, okay, so you can go to settings and set your home page to be one of several pages If you'd prefer to go to the trade idea generator or portfolios, one of these other things, you can do that, and then your home button will always go there, and then the dashboard will always bring you to the dashboard. But yeah, we do have some quirky things with our navigation that we're looking to clean up at some point, Rick. So thanks for that note. And then the next question is about Snap. So Rick's question is, with Snap recently thinking, is it time for a bear put spread or to sell a put? So first of all, those are two very different trades, right? So a bear put spread is a bearish bet on the stock. Okay, we're going to bet that the stock will, let's see here, I don't think, yeah, we didn't even come up with a bearish put spread for this today. But a bearish put spread would be, say, just for grins, sell the 9 and buy the 10 for a credit, and that's a bet that the stock will stay below $9. That is one thing you could do if you were convinced the stock would stay below $9. Selling a put, as we have here, is very much like a covered call, right? The icons are similar because the risks are similar. So in this case, right, on a covered call, we buy the stock and sell the $7 call. We get a net debit of $5.28. And so we own the stock. We'll sell it above $7. And so at that point, on January 15th, 2021, we would, if the stock is above $7, we would no longer own it. And if the stock is below $7, we would continue owning it at a cost basis of $5.28. A sold put, what we do is we can sell the put. We don't have to buy the stock or anything. But if the stock is above $7 on the same day in January of 2021, that put expires worthless, and we make $1.59. If the stock is below $7, the shares are put to us. We buy them for $7. We collected this credit of $1.59. So in that case, our cost basis is $5.41. The two trades have very similar risk and rewards. There's some difference in terms of like dividend and interest earned on cash and things like that you might want to do one or the other. But typically people sell puts if it's on a stock that they're interested in owning, but they want to own it at a discount, which maybe that's the case with Snap. I don't know. All of this sliding with Snap seemed like it started back in the springtime when Kylie Jenner tweeted something about not using Snapchat anymore, which if she's an important person to the Snapchat audience, it makes sense the stock would fall off a cliff. But I try not to make too many investment decisions that are going to be won or lost based on the whims of teenagers, because who knows? So yeah, as far as I'm concerned with Snap tanking, I'm still staying away from it just like I was when it was going up, because I have no idea. I had Snapchat briefly, and the user interface was all swipe this way for one thing and swipe another way for another thing, and it made me feel very old, and I got rid of it. So yeah, I don't really have a good idea of what to do with Snap. It seems like a stay away is really how I feel about it, more than having any strong bias in one direction or the other. So Kit asks, does the diagonal spread portfolio include bullish and bearish diagonals? And the answer is yes, it does. We have done more bullish trades than bearish trades, but that is the way it's worked out. I think right now it might be all bullish. Yeah, it's all bullish trades right now, but we did close a bearish one this morning. Yeah, we closed a bearish one and a bullish one this morning. Weibo, we closed for full profit today. That was bearish. And then Intelsat, we closed today. That was bullish. But yeah, by and large, it's been more bullish than bearish. But that's been the market we're in generally. So that's why that is. All right, so we have a question about Papa John's and also about web browsers. So Rick asks, is Chrome the preferred web browser for I/O? It is the web browser that I use a lot, so that's why you see me using it the most. It's my personal preference, but we have people here who use Chrome. We have a Safari user. I think we have some Firefox users. In terms of our programming staff, I think one of the guys changes browsers. He's used Opera and Bravo and some other things I've never heard of. And we do try to test things in as many browsers as possible. But Chrome is probably the one that gets the most use. I can tell you from looking at analytics that most of our users are using Chrome. It's like Chrome, Safari, and then some combination of Internet Explorer, Edge, and Firefox are all kind of tied with each other for third place. But yeah, Chrome and Safari are the big two, and I think a lot of that is also because of mobile. Android, Chrome is the default browser, and Safari is the default browser on all your iOS devices. So that's probably why those two are the highest like that. But yeah, pretty much any browser that's relatively recent should work. They all have some quirks, but I don't know that one is better than the other in any real sense. All right, so PZZA. Yeah, it's starting to come back. They had troubles with their CEO and founder and the actual eponymous Papa John earlier this year, but the stock is starting to come back. I don't have a good sense of what typically, I mean, very similar to the case with Snap. Once things start to trade on things that are hard to predict and understand, I tend to just stay away with them. You haven't seen a lot. I mean, I've done trades on Papa John's, but not recently. I think I may have done trades on Snap, in fact, but not recently. But I have the same thing about Tesla, right? Like Tesla doesn't seem to trade on indie fundamentals that make sense for a car company. It seems to trade a lot on how people feel about Elon Musk on a certain day. And that's not a thing I feel like I have any kind of edge or ability to, right, like even make guesses about with any reasonable certainty. So it's just to stay away as far as I'm concerned. And I mean, Papa John's looks like it's coming back, but there's some lawsuits out there with the founder, right? He wants control of the company back, and the management of the company is like, no, we don't want to give you this company back. How that ends up, I don't know. I mean, I don't know that pizza, I mean, there's a case to be made maybe that it's undervalued because it sold off so hard earlier. If you want to trade pizza, Domino's maybe looks a little bit healthier as far as that goes. I don't know. Go back and forth here and look at some valuations. Yeah, I mean, Papa John's does have a lower PE, which if you're trying to trade it on valuation, then maybe you take the one with the lower PE. And yeah, I mean, Yum Brands is Pizza Hut, but I feel like they're probably more Taco Bell than Pizza Hut in terms of revenue at this point. But I don't know off the top of my head. But yeah, I mean, I generally try to stay away from things that are where the stock gets whipped around by things that I have no ability to even make guesses about, right? I mean, We don't trade a lot of energy stocks here for that reason also. There's too many things that are hard to model and things like that, like retail. Retail is a thing we can understand. You can kind of get your head around it. You can look at consumer confidence and things like that and make some guesses about where it's going. That's the thing I'm cool with. A lot of the tech stocks are relatively, if not easy to understand, there certainly aren't, right? You're not putting the hands of the share price in capricious teenagers or juries or things like that. And so, yeah, I'd much rather try to trade those things on either technicals or fundamentals than these, things that are in the news a lot and trade on I'm not sure what. All right, the square diagonal. Yeah, I'm not particularly worried about it. Yeah, I don't know if something's happened in the last 40 minutes since I walked here with Square. It doesn't really look like it from the stock price, but it's doing pretty much what I expected. Right, like I expect it to kind of stay about this level. I don't really need it to get up and run away. I'd like to see it stay above 95. Our break even is down at 92. So even if it went down in the vicinity of these old highs, we're still, we can roll it, sell another call, and pull that breakdown even further and be okay. So yeah, I'm not particularly concerned about that one. We're keeping an eye on it like we are all the other ones, but that one in particular, I don't have any special concern about. Yeah, I spend a lot more time looking at EA and UPS in the last couple of days than I have the Square. All right, any other questions? Yeah, E-Trade. Let's go back and look at that one. E-Trade's in a similar boat to the EA diagonal we talked about earlier. We're looking to sell another call against it. This one is nominally stronger and the loss is a little bit smaller. But yeah, we're looking to sell another call against it. It's just been, all the financials have been super weak the last couple of weeks, which is interesting given the rising interest rates. You normally expect them to be stronger. But yeah, we're looking to sell another call, but we are also mindful that it has earnings in 2 weeks. So yeah, I'm not interested in holding it through earnings particularly. The retail broker space has gotten incredibly competitive in terms of price. I think Schwab started that late last year, early this year, in terms of just aggressively cutting commission prices, and everybody has kind of followed suit. You've seen, I think Fidelity is offering some no commission trades now, and I think they have a no load ETF now also, which, yeah, I'm not. Fidelity's not a public company and they make plenty of money, so I'm not going to spend too much time worrying about their future profitability. But at some point, if you cut the fee for all your services to zero, you've got to make money somewhere. But yeah, we're going to do what we can with E-Trade and then be out before the 18th when they report earnings. Yeah, if there's any more questions, put them in the box there, and I'll be glad to answer them. Like I always say, I plan to be here for the whole hour. So yeah, anything else that anybody has, just let me know. I'll hang out for a few more minutes. All right, we got another ticker here. I'm not super familiar with this one. All right, yeah. Yeah, this is a biotech. And yeah, it's having a hell of a day today. That's most of what I say. What I have to say about it. I assume it probably got some good news. It didn't make it into our news headline there, but yeah, I assume they got some good news about one of their drugs in development today, and that's why it's up so much. But I don't. Yeah. Beyond that, I've literally never looked at this before. Especially the super small cap biotechs are not something we mess around with. It's very hard to know how those drug trials will turn out, and even when they'll be announced. So you know, earnings comes 4 times a year. It's usually on a calendar. We can try to plan around it, so we're not in a position at that point. But yeah, I mean, I've seen stocks lose 40% in a day on a drug trial that went the other day. So yeah, I don't really know much about it beyond that. Yeah, I mean, insider buying could have something to do with it. That seems a little bit seems to be a little bit weird that it would go up that much just on insider buying, but I don't like I said, I don't actually know. All right, we have a question about our UPS portfolio position here. Which, yeah, it's largely a story about oil prices, as far as I can tell. I don't think there's anything in particular going on with UPS. There's always some noise about UPS and Amazon getting into the delivery business, but I think I think Amazon is doing enough package volume that they're going to have to work really, really hard to scale up to compete with UPS. So yeah, we'll look again at selling another call against this one. You know, that expires the end of next week. So we'll be looking at that as in our usual checks. It hasn't quite gotten to the point where we saw anything attractive yet, but it also has earnings towards the end of this week. So we'll want to be, or toward the end of this month, so we'll want to be out of it before then. But yeah, I mean, if oil prices kind of look like they might be ebbing a little bit here, we'll see. I don't like really being an oil trader because it's very complicated and there's too many weird news headlines that happen that affect the price of oil. But generally, it's a lot different market than it was 10 or even 5 years ago. But yeah, it does seem like they're kind of rising a little bit, but I'm not super worried at UPS. I think we may be able to get something out of it if the stock will cooperate with us a little bit. But yeah, we'll see. We will be looking to sell another call on that one pretty soon, though. All right, so I mean, yeah, Rick, financials are supposed to do well in a rising interest rate environment, and I don't 100% know why they have done so poorly the last few days. It's been a topic of discussion on a couple of things that I have been reading and listening to recently. I mean, borrowing costs for banks are typically lower than the lending rates. So I mean, traditionally banks have made money on the spread. So I guess with some flattening, maybe there's a risk of less less profitability there, but net interest margin especially in the banking space isn't what it used to be. banks have really gone to collecting fees. So yeah, I don't know. I mean, is it possible that interest rates have risen enough that mortgage originations or something like that slow down, and that's why they're losing? I don't have a good answer for that, and I haven't really seen one from anybody else either. Yeah, I mean, so Rick follows up with higher borrowing costs for the consumer means a higher possibility of loss. I mean, in theory, Rick, interest rates are a function of risk, right? Like a high risk borrower will pay higher interest than a low risk borrower. So I mean, there's a case to be made that if interest rates go up, suddenly default risk increases sort of on a systemic level, but I don't think we've seen that kind of move in interest rates. And we haven't seen anybody announcing, I mean, I was not here, but I was around in 2008 when, things were happening there, and it doesn't seem like that kind of thing in terms of higher defaults are actually happening. And so yeah, I don't have a good answer for why the financials have responded to rising interest rates the way they have this time. It doesn't make sense to me in any real way. And like I said, I haven't seen. I try to read a lot of things from a lot of people who are smarter than me, and I haven't seen anyone really be able to answer it there either. All right, so like I said, we have a few more minutes. If anybody has any more questions, feel free to send them in. Anybody who wants to participate in that beta test, we're pretty excited about the stuff we're working on. Shoot a message to Rob. I think he gave out his email address earlier, or you can always use the help button to get in touch with us with webinar questions, interest in our beta test, or anything else that you're interested in. Have a question about, shoot it to us. If you have a question, you don't have to wait to get it answered in one of these sessions. We're happy to answer questions anytime. But if you have something that you'd like to see on slides or doesn't need to be answered immediately, feel free to send it to us. I like to have the some things on slides for these presentations. I think it's valuable. Yeah, I don't know, Rick. I still see talk about the inverted yield curve. I feel like it's less in the news than it was because there's other stuff in the news. But yeah, I think people are probably more interested in watching things about Elon Musk or what's going on in the Senate or the Supreme Court confirmation process or trade than discussions of the yield curve. Like, I mean, I think that's actually some of why you're seeing less talk of it. I don't think it has gotten any steeper recently. And I've still heard, I still hear about it a little bit. But yeah, I mean, it has dropped out of the news a little bit. I tend to read some pretty wonky stuff, so I still hear about it occasionally, but it's certainly, I certainly haven't seen anybody on CNBC talking about it a whole lot super recently. So yeah, I don't know. It still seems to be about as steep as it was when we talked about it that was probably a month ago at this point. Yeah, I don't think it's gotten less steep. I think both ends of the curve have moved up a little bit. But yeah, I don't have a real sense of that that has gone away. I think it's just gotten out of people's minds because there's more interesting things to talk about. All right, so as always, we'll send out a copy of the, we'll send out a video and a copy of the slides we used today, probably tomorrow morning. And we'll also have a link to register for the next webinar at that point, which will be sometime around October the 24th. So yeah, thank you all for coming. And yeah, look for that in your email tomorrow, and it'll also be in the Market Intelligence Center section of the website. And until, I'll talk to you in 3 weeks, or, like I said, use the help button or give us a call if you have a question before then. Thank you.